Okay, so now one of the things that you're going to be concerned about as we get older is your health. And we've heard about strong bodies and taking care of yourselves, etc., etc. But one thing that we do know we need is medical cover. And we probably have been using it for some time during our working careers. And one of the realities, of course, is as we get older, chances are we're going to use it even more. So we probably need to get our health cover sorted, don't we? Well, to help us with that journey is the head of scheme consulting at Alexander Forbes. Please put your hands together for Anthea Towert.
My usual. Just being secure in who you are and what you're about. What are those again? My alarm clock. My family and my love for what I do. Passion to make a difference in the lives of the people that I meet. Good morning, ladies and gentlemen. It's lovely to be here. We've had a very inspiring and colourful presentation from Kathy on building a bridge from our employment into our retirement. And before tea, John and Anne started to explore some of the practicalities around retirement planning, retirement decisions. And I'm now going to focus on one which I think in the past has often been overlooked, but which gains increasing importance as we move from employment into retirement, from that third chapter into our fourth chapter. And that's about getting our health cover sorted. It's important because as we age, so we consume more healthcare, and that becomes a very important decision. Now, to set the context for my talk, I thought I would just share a little bit with you about the environment within which medical schemes operate. Because medical schemes, in our view, are the cornerstone, the foundation of your health cover. Once you've got that as your building block, you can then purchase additional forms of health cover to supplement your medical scheme. So we have basically two types of medical schemes in this country. We have open medical schemes, which are schemes that anyone can join, regardless of who they are employed by. So schemes like FedHealth, Momentum, Discovery, Bonitas, those are open medical schemes. And then we have what we call restricted medical schemes. And those are schemes that have been set up by particular industries, like BankMed for the banking industry, the government employees medical scheme for civil servants. And you need to be part of that community in order to belong to that medical fund. But whether you are a member of a restricted or an open medical scheme, the rules and the regulations are exactly the same. So a medical scheme is actually a non-profit entity. It's not there to make a profit. It receives contributions from its members, and with those contributions, it pays the claims and expenses. It can't raise capital on the JSE in order to rectify any imbalances. So it is a non-profit entity. Where the profit incentive lies is in the third-party contracts that schemes have. So a scheme would contract with an administration company, it would contract with a managed care organization in order to provide the operational infrastructure to manage that fund. And it is those parties that receive a per member per month fee and have a profit incentive to manage that to their advantage. So those are the sort of the key players from a funding perspective. Now, a medical scheme, in order for it to be sustainable long term, it needs to balance the scales. If the expenses and the claims of the members outweigh the contribution income that the scheme receives from member contributions and from investments, then we have a situation where there's an imbalance. And there are only two levers that a scheme can manipulate in order to rebalance those scales. It either increases your contributions above more than the average, or it restructures your benefits. There aren't any other levers that the scheme can use in order to bring those scales into alignment and create sustainability going forward. So in our environment, of medical scheme cover, there are really three parties that play a critical role. The first is your health professional, your doctor, your specialist, your occupational healthcare provider. They're clinically trained and they spend a lot of time being trained, but we do have a shortage of health professionals in our country. And we also have an environment where there's no regulated tariff. So a doctor sets his own rates. There's no regulatory tariff, so he sets the rate at which he charges for his services. He also holds the clinical information, the ability to clinically diagnose and to treat you. He holds that information. The scheme is the funder. They are there to pay your claims. And they reimburse the majority of the claims that they receive at what we call a scheme tariff. So they set a tariff of reimbursement. But there is a subset of claims that a scheme receives called the prescribed minimum benefits. You might have heard about it. And I've written an article in the magazine that tells you a little bit more about the prescribed minimum benefits. In our law, the prescribed minimum benefits must be paid for in full at whatever cost has been charged by the provider. So that is quite an onerous responsibility on a medical fund. And then you have us as members of medical schemes. We're the consumers. And unfortunately, we're the piggy in the middle because we are responsible for any shortfalls between what our doctors charge and what our medical schemes reimburse. We are also faced with a huge amount of information that is often very confusing, very complex. We receive these booklets, beautifully illustrated booklets on medical aid options and how to claim benefits and what benefits we are entitled to. So we can find it very confusing. And really, at the end of the day, there is an imbalance of power between these three parties. You might have heard that the Competition Commission has started an inquiry into private healthcare. It's currently underway. And on their website, on the Competition Commission's website, you can go in and read the various public submissions that have been made from different quarters of our health industry, providers, funders, doctors, regulators. And that'll give you a very good idea of some of the dynamics and some of the challenges facing our industry. Now, as you sit here and you're in this third chapter of your life and you're needing to start to plan for your retirement and to consider your health needs in retirement, there are three important considerations that you should bear in mind. The first is the financial stability of the scheme that you're going to belong to and take into your retirement with you. Secondly, if you're looking to potentially change your medical scheme from one to another, you need to understand what are the implications and what are the challenges that could present themselves if I were to take that decision. And lastly, what is the role that health insurance plays in any decision that I make regarding my medical scheme cover? So let's unpack this a little bit, and we'll start by looking at the financial factors. There are really 5 key financial factors that you should be aware of when you are assessing various medical schemes. The first is size and growth. Now, our industry has, over the last 13 to 14 years, been consolidating. We have fewer medical schemes now than we had in the past. So we've seen smaller, less stable medical schemes merging into larger, bigger funds. And so on average, we've got just over 87 registered medical schemes in the country with an average membership of just over 100,000 belly buttons or beneficiaries. What this graph shows you is what the top 10 medical schemes in the country look like in terms of size. You can see we've got 2 very big dominant players in our market. The one is Discovery Health Medical Scheme in the open market and GEMS in the restricted market, and then a couple of schemes in between. So size plays an important role in determining financial stability because the larger a scheme is, the more stable the claims experience on the scheme. But in addition to that, growth is important. The principles that underpin medical scheme cover are called social solidarity principles. The young and healthy subsidize the older, sicker members. So a scheme needs to be getting in younger and healthy members on a continuous basis in order to provide sufficient contribution income to cover the claims of the older, sicker members. That is the concepts that underpin medical schemes. So where we have the icon sitting above the line, those schemes have grown their membership in the last year. If they sit below the line, they've seen a reduction in membership. Age is another key determinant of financial stability, because as a scheme ages, so its claims increase, and as claims increase, we see it coming through in higher contributions. It is said that for every year that a scheme ages, the claims on that scheme will increase by 2%. So that's why it's so important for a scheme to be growing in its membership. Financial results are also very important. A scheme that is unable to cover all of its claims and expenses from its contribution income is going to sit with a deficit, and the only way to get rid of that deficit is for them to increase their contributions so that they can get more funds into the system to pay for the claims. And as you can see across the top 10 medical schemes for 2013, there were about 5 medical funds that weren't able to cover all of their claims and expenses from their contribution income. They had to at some point be reliant on investment income to balance the scales. Also, schemes have to maintain a certain minimum solvency. So what do I mean by that? A certain portion of contributions must always be held in reserve in case some catastrophe hits the medical scheme, like the Ebola epidemic hitting our shores. Can you imagine what impact that would have on the claims submitted to medical funds? So schemes have to maintain reserves of a minimum of 25% of contributions. And any scheme that is below that level would need to grow their reserves through higher than average contribution increases over time. And then lastly, contribution history. Whether the extent to which the contribution increases on a medical scheme fluctuate from year to year is an indication of whether that scheme is able to price its benefits appropriately and is able to manage its risks. And when we talk about contribution history, it's important to understand what underpins medical inflation and the impact that medical inflation has on contribution increases. And Jeff spoke about that in the very first session. He said that's one of the risks, the post-retirement risks that one faces, is the impact of medical inflation. Now, we've been measuring medical inflation over the last 14 years as Alexander Forbes Health. And consumer price inflation over that period has averaged 5.8%. Medical inflation has averaged 7.9% over that period, so 2% more than inflation. But interesting to note, and a concern, is that the contribution increases announced by medical schemes on an annual basis have averaged 9.7%. That's 4% above inflation over that period, and that's significant. So one needs to ask the question, what is driving medical inflation? And really, there are some very key reasons why medical inflation is sitting where it is. Firstly, our health professionals, as I said before, they set the rates at which they charge for their services, and there is an inflationary element to that. Secondly, we have a rising disease burden, not only in South Africa, but internationally. The incidence of non-communicable diseases like heart disease, high blood pressure, high cholesterol, diabetes is increasing at an alarming rate. In fact, global health estimates have projected that by the year 2030, which is only in 15 years' time, the incidence of new cancer cases in South Africa would have risen by 46%. So because we have a rising disease burden, there is an increasing demand for healthcare, an almost insatiable demand for healthcare cover. And that compounded by new technologies, which are amazing and fantastic. I mean, 20 years ago, you'd never heard of keyhole surgery. Now you can go in for an operation and cut your stay in hospital by almost 70%. So technology has certainly increased morbidity, reduced mortality, but it has come as a significant cost. And then at a scheme-specific level, there are those schemes that have to build reserves, so that increases medical inflation. And then very importantly is the prescribed minimum benefits. That set of benefits that all schemes must provide as a basic level of cover to all members comprises about 53% of all claims that a scheme receives. And as I said before, those claims must be paid for in full by the medical scheme at whatever cost has been charged. So that has an inflationary impact on medical funds. So hopefully by unpacking some of that, it gives you a bit of an understanding of what's driving medical inflation to be so much higher than CPI. So having looked at the financial factors, let's now consider underwriting. And this becomes important when you're considering whether you want to change from one medical scheme to another. If you are a member of an open medical scheme, that scheme has to, by law, provide you with cover until the day you die. You've got guaranteed cover on a medical fund. So if you're wanting to switch from one scheme to another, that is considered a voluntary move. And as a result of that, a scheme could then impose underwriting on you. So what does that mean? It means that the scheme could impose a waiting period during which you are unable to access benefits. And depending on whether you've had previous cover before and you're over the age of 35, you could also be in line for what we call a late joiner penalty, which is a premium, a contribution loading on your premiums. My advice to you, and I know we're not supposed to be giving advice on the stage, but what I'm recommending to you is that before you choose to move from one medical scheme to another, make sure that you receive a letter of acceptance from the new scheme and you understand exactly what potential underwriting considerations could be applied to your membership. And then the third consideration is to look at the role of health insurance. With the cost of medical inflation and medical contribution increases increasing at the rate at which they have been, consumers have been starting to talk more about replacing medical aid with health insurance, because health insurance is a cheaper form of insuring your health risks. However, in my view, health insurance does not replace medical scheme cover because it carries too many risks. It's certainly a fantastic way of supplementing your medical scheme benefits, but it's not there to replace. And what I've listed on the screen there are some of the key differences between health insurance and medical scheme cover. The most important being that medical scheme cover is guaranteed for life, whereas health insurance is an annually renewable contract. Secondly, the policy benefits that get paid out by health insurance are an annuity. They're a fixed rand amount versus medical schemes that reimburse the actual cost. And also one has to look at the tax implications. Health insurance does not receive a tax deduction, whereas your medical aid contributions do. So those are some of the key differences between health insurance and medical scheme cover. And because of the risks associated, I do not believe it makes for a good replacement, but it certainly can supplement and plug those gaps that you could have with your medical scheme cover. So now we've looked at the considerations which are important when you're potentially changing medical schemes and finding a scheme that would meet your needs in retirement. Let's have a look now at what you should consider when you're deciding what option to choose on a medical scheme. And this is where a lot of the confusion comes in for the members, because you generally receive this brochure from the medical aid, and if it's the Discovery Health Medical Scheme, there are 22 different options that you can choose from. Now, how do you begin to decide which option is best for me? Then the next layer would be your day-to-day benefits. And generally with basic cover, you don't have day-to-day cover. It's purely hospital and chronic. If there is an element of day-to-day cover, it would be very minimal. But then as you move into the medium and comprehensive ranges, you will see far more day-to-day benefits and richer benefits being provided. And then lastly, your supplementary cover. And that would be your preventative and screening benefits, and possibly also the loyalty programs that come with some of these products, which actually sit outside of the medical scheme. They're not part of the medical fund. So that's how schemes actually structure their benefits. So when you as a member are now considering what option to choose, always bear in mind that you can change your option on the 1st of January every year. You're not locked into an option for more than one calendar year at a time. There are some schemes that do allow you to change your option more than once a year on the diagnosis of a chronic condition like cancer, for example. And that can be very beneficial because at that point you're able to upgrade your benefits and reduce your risk. Secondly, look at how the options pay your benefits. Are you getting full cover? Because often medical schemes negotiate with providers, with designated service providers, and they say, if you use our hospital network, our doctor network, our specialist network, then you would have full cover. But if you go outside of that and you use your own providers, then you could be in for a shortfall. Free choice comes at a price, but free choice also means that you carry more of the risk. Then benefit access is another important point to mention. If you're prepared to work within a closed environment of contracted providers, you can actually get very rich benefits, but you're sacrificing choice. So one has to weigh up, the advantages versus disadvantages of choice versus a restricted environment. And then benefit limitations. How are the benefits on my medical aid limited? Is it a random amount? Is it a co-payment? And very importantly there, to look at the medication formularies that underpin the various disease programs that the scheme offers. So we've had a look now at the considerations when choosing a medical scheme and some of the considerations when you choose an option on a medical scheme. And I want to spend the next couple of minutes considering the need for medical cover in retirement and looking at the costs associated with that. So I've shown this graph a little bit earlier, but I think it's such a powerful one because what it is depicting here is how the claims, the medical expenses of an individual increase with age. As you can see very clearly, when you're young, into your 20s and your 30s, your claims cost is pretty stable. But as you move into your 40s, 50s, and then very much so into your early pre-retirement years, your medical expenses increase quite significantly. And then into retirement, there's an exponential increase in medical expenses. So given that that is the average claims curve for an individual, it makes sense then that you choose a level of cover to meet your life stage. So to illustrate this, and I'm going to borrow from Kathy's talk a little bit. When you're in that speedboat phase of your life and you're crossing those waters at significant speed, leaving a wake behind you with no limits and just going for leather, in that phase of your life, in your 20s, the type of cover that you would generally require would be good hospital and chronic cover. Insurance, in other words, knowing that if I'm climbing a rock face and I fall off the mountain, or if I'm involved in a motor vehicle accident, I've got good protection. Then we move into the third chapter of our lives, that cargo ship phase of our life, when we're having families, raising families, building our careers. That's where we need more comprehensive cover. We need now some day-to-day benefits. We need good maternity care. And so we would look at a medium level cover for that chapter of our lives. And then when we move into retirement, that's where we need our most comprehensive benefits, because that's often when we've got one or more chronic condition that needs regular maintenance and medication, and then we need richer day-to-day benefits. So one should ideally life stage our health coverage depending on the chapter of our life that we are in. The complication comes in when you consider the costs involved. And what I've put up now are the 2015 prices of different levels of cover based on the Discovery Health product range. So as a retiree with a spouse who requires comprehensive cover, you're looking at a cost between 6,000 and 7,000 rand per month in today's money terms. And that's really where the dilemma comes in. This dilemma of our health needs versus our ability to pay. And it's no more better illustrated than through this graph here. We've got the claim curve, which is in red, But then overlaid on that is our ability to pay. So one can clearly see that when you're in your active working life, your ability to pay far exceeds your health needs on average. But when you move into retirement and now you're on a fixed income, that's often when your health needs greatly exceed your ability to pay. So how does one deal with this dilemma? What is the solution? Unfortunately, there's no easy solution. There's no simple fix. What it requires of us is that pre-retirement, we pre-fund, we save for our healthcare, medical aid costs and contributions for retirement. So while we have the ability to generate income that exceeds our health needs, we should be setting aside some money in order to fund our contributions in retirement when we're on a fixed income. And to illustrate this and also to unpack some of the costs associated with medical aid cover in retirement, I'm going to use this case study. We're going to assume that our main member is a 55-year-old married male with a spouse who's 4 years younger than him. He's a very lucky man. He's due to retire at the age of 65, and in retirement he's not going to receive a post-retirement subsidy. He's going to carry the full cost of his contributions. We are also assuming that medical scheme contributions are increasing by CPI plus 4% a year, and any pre-funding that, let's call him John, is able to make would increase by CPI plus 1% with a return of 4% above inflation. So fairly conservative, but I do feel realistic assumptions in order to paint this picture for you. So now dear old John, with his wife, if he were to set aside a lump sum today, at the age of 55, that he would put away and invest and not add to for the next 10 years until he retires at age 65, if he wants to pre-fund with a lump sum for comprehensive cover, he would need 1.5 million today that he can invest. If he's looking to fund for medium cover, he would need to put away today 850,000. And if he's looking to at least provide cover for a basic level of cover, it would cost 630,000 as a lump sum today. Now, I'm sure you'll agree with me. Not many of us have got this money lying under our mattress that we can just go and invest tomorrow and, forget about for the next 10 years. Most of us, I'm sure, have not contemplated the need to specifically provide for our healthcare cover in retirement. And so we would be looking today to start making a monthly contribution to a pre-funding vehicle for our post-retirement medical aid contributions. And so John, if he wanted to start making a monthly contribution today at age 55 for the next 10 years, if he wanted to provide for that comprehensive level of cover in retirement, it would cost him 15,200 Rand a month. Okay? For medium cover, it would cost 8,400 Rand a month. And for basic cover, 6,200 Rand a month. So these are really big numbers that we're talking about. And when one is considering to pre-fund and to set aside money for your healthcare in retirement, an important consideration to always bear in mind is your investment return. Because we have medical inflation that is running at 4% above CPI on average. So you need to be able to generate an investment return on your pre-funding money that at least equals, if not beats, medical inflation. So if John is able to invest in an investment that gives him a return of CPI plus 6% as opposed to CPI plus 4%, he's then able to reduce his monthly contributions by as much as 28% over that 10-year period. So investment returns are an important consideration when you're looking to pre-fund for your retirement. Now, I'm sorry I had to shock you with those numbers. It is rather a depressing thought. But you do have very good chronic cover on your medical aid, and major depression is a prescribed minimum benefit, so you are able to get your Prozac if you need it, okay? And there's quite a big incidence, we see an escalation in the incidence of mental illness, and maybe the cost of healthcare cover has got something to do with that. But on a more serious note, you could be sitting here and thinking to yourselves, well, these numbers are just so daunting and so out of the ballpark that I just can't possibly think of where to start. We do sit in a situation today in South Africa where private healthcare cover is preferred to public health. And I think one can safely say that that's going to be the answer for at least another 10 years, because national health insurance still has some way to go before it can replace private healthcare cover and one's expectations around that. So until such time as national health insurance becomes a reality, we have to go the private funding route. And so there are some tweaks that one can make to your decision-making process now. Unfortunately, there's no wonderful solution, but there are some tweaks that you can look at. And I want to just discuss some of them with you in the last few minutes that I have. The first is to understand your current healthcare needs. Don't be over-insured today. Choose an option today that meets your health risk, but don't over-insure. If John today, at age 55, was on a medium option as opposed to a comprehensive plan, he could save himself 3,000 Rand a month, which he could then put into a pre-retirement, pre-funding vehicle in order to invest for his post-retirement medical aid contributions. Secondly, maintain a healthy lifestyle for as long as you can. It's not to say that the day you retire, you must be on a comprehensive medical scheme. No. It depends on what your personal circumstances are. So if you're able to eat healthily, exercise, keep yourself healthy, you can delay the point at which you would need to purchase comprehensive cover. Third, save as much as you can now. Every little bit will help. Doesn't matter how much it is. But just remember that investment returns should be targeted to beat medical inflation. And then lastly, which is probably not something that you want to hear, and I guess you could look at this positively or negatively, work for longer. Maybe a second job, doing some consulting work, doing the books for an organization, doing something that generates an income. If John delayed his retirement by 5 years, and instead of retiring at 65, he retired at age 70, the lump sum he would need for medium cover would reduce by 19%. And that's quite significant because he's saving for 5 years more, and he would then need cover for 5 years less once he's in retirement. So ladies and gentlemen, I hope that what I've shared with you today has provided you with some insight into the importance of putting health funding on the map of your financial plan, planning for your health cover in retirement. And hopefully I've given you some practical tools and considerations that you can take away with you that will help you make this decision and be able to retire in a more comfortable position as far as your healthcare is concerned. So thank you very much.